Hey folks, it's Simon here with your Tower Daily for Friday the 30th of August 2024. Happy Friday to you. Markets finished yesterday pretty much flat, but that was after an attempt at a rally earlier in the session. It looked as though markets were going to step over the disappointing reaction to NVDA, but alas, that wasn't the case in the end. Now, okay, NVDA was down 6%. That's kind of not the end of the world. A couple of stocks that had much bigger moves than NVIDIA one was Dollar General. This stock was down 32% on disappointing earnings. Dollar Tree as well was down 10%. This stock is now down over 50% from its highs, with the CEO noting that core customers are financially pressured. So this is an ominous sign that less affluent consumers in the US economy are feeling the pinch. They've run out of fiscal stimulus. And this is all happening at a time where the unemployment rate, while still relatively low, is accelerating higher. So here's a fun chart of what happens when the unemployment rate starts to surge higher, in this case breaking its 27-month moving average. So we've got a clear break of that here. And in every prior instance since 1950, it has meant that a recession has followed. Now, a lot of ink was spilled yesterday on the second quarter GDP revision. It got revised up from 2.8% to 3%, which in a lot of people's minds ensures a soft landing. Just a reminder, though, that at inflection points, GDP numbers are notoriously misleading. All right, the US had a recession that started in March 2001. Now, in April 2001, the March 2001 GDP print was 2%. And then it took 5 subsequent revisions to get down to minus 1.3%, and that's kind of where it stayed. And the NVDA declared that the recession began in the March quarter, even though the GDP print at the time was 2%. All right, so at inflection points, this data can be very unreliable, and the unemployment data suggests that we could be at an inflection point. Remember last week we saw the biggest revision to non-farm payrolls jobs added since the global financial crisis. They were revised down 818,000 jobs from March 2023 to March 2024. All right, so the employment situation does seem to be deteriorating fairly rapidly. That's why it is in the Fed's focus. Well, that's okay, you say. If the Fed are alert to the declining employment situation, they'll give us a 50 basis point rate cut in September and everything will be okay. Well, be careful what you wish for. Interesting chart here from Charlie Bolello. When the Fed begins an easing cycle with a 50 basis point cut, the forward returns for the S&P 500 are horrendous. And that's because the Fed only begins an easing cycle with a 50 basis point cut if they see something coming down the pipe that the stock market is really not going to enjoy. That's what I got for you today, folks. I hope it helps, and I wish you a wonderful weekend.